Thanks for joining us for the Executive Series. Today I'm speaking with Kurt Winrich, who is the co-CEO of WCM Investment Management. He's also a portfolio manager of the Contango Global Growth Fund. It's good to talk to you, Kurt.
Great to be here, Tom. Thank you.
Now, in the past, when we've spoken to representatives of your group, the one thing that we've really honed in on is the investment methodology that sets you apart from your peers. And that's an important distinction, isn't it? It really comes down to the culture within organisations that you invest in.
Yeah, culture is a very important part that undergirds, I think, what we do differently, even in looking at how a business is positioned. One of the things that a lot of people will tell you is that they want to own a business that has a great big competitive advantage, and they want to buy it at a cheap price. So a lot of times you hear the word quality thrown around with that. We often say, if everybody's trying to do that, how do you expect to have a different result? It's hard to think about that. What we've noticed is that, just frankly by making mistakes over the past 30 years and learning from them, is that it's not the size of the competitive advantage that really matters, it's how it's changing. I like to illustrate it all the time with a story about one of the most famous companies in the world, at least 10 years ago, the Finnish cell phone maker Nokia. Nokia was on top of the world 10 years ago. They were invincible. In fact, there's research reports I have that call it inevitable, buy in 2007. They were the fifth most valuable brand in the world at the time. They had better margins than anybody. They were safe. They were high quality. They were a wide moat, we call it, competitive advantage at a discount. Really good, right? Every growth manager owned it. 10 years later, you look at them, they've lost 90% of their market value. They sold their name to Microsoft, who recently sold it again for 1/100th of the value that it was in 2007. What happened there? That was the safe, wide moat business. Its competitive advantage was deteriorating. That, we think, is the most critical thing. You avoid those, you find businesses that are growing their competitive advantage. Where culture comes in then, which we think is not looked at by hardly anybody, is culture helps to sustain those competitive advantage growth curves a lot longer than anybody expects. And the net for us is, if we can buy businesses that outdo expectations that everybody has, guess what? Those are the outperformers.
Indeed.
Pretty simple.
So sticking with that element of investing in organisations that tick all the right cultural boxes for you, that also helps you in terms of navigating the investment cycle as well, doesn't it?
To a degree, yeah, it does, because if you find businesses that are able to, by virtue of the cultural ethos, the core values, if you will, are able to look past the short term to the long, then you've got businesses that can have a real edge in their competition. It's one of the reasons we like Jeff Bezos at Amazon. He's famous for saying, if our planning is only in the 3-year time horizon, we're competing with every business on the planet. But if we are able to look at projects that don't have to have a return for 7 years or 10 years, nobody's thinking out there. We have no competition, and we can win the game. That's the kind of thing that a culture imputes or imbues into a business. It's a mindset that helps a business win, and that's what we want to be partnered with.
Okay, so let's dig a little bit deeper in terms of the composition of the portfolio, because you have, interestingly, been reasonably underweight when it comes to the FANG stocks most recently. What's informed that approach?
Yeah, and it's a great question to ask, because it's not that we don't like the FANG stocks. We own Facebook, we own Amazon, we don't own Netflix. We have owned Google in the past. In all of them, though, the key thing for us is an overarching principle in our approach is to try to minimize the downside risk. I've been quoted as saying you win by not losing. It's the sort of simple math that everybody knows, but if you lose 50% in your portfolio, it takes 100% return to get back to even. 100% returns don't come along very often. If you can limit that loss to, say, 20% during the GFC or something, you only have to have 25% to get back to even. That's a lot more achievable. So we set out to focus on protecting that downside. What that means with the FANG stocks is that they've had great runs. I mean, Amazon goes up 100% in a year, Facebook goes up 100% in a year. Wonderful things. Guess what? They become pretty big parts of the portfolio when they do that. Our approach is to trim them, to take some money off the table. There's an old Wall Street story that I don't know if I totally believe, but it sounds good here. Nobody ever lost money by taking profits.
That's That's a truism, isn't it? So tell us a little bit about the organisations that you are more focused on as they emerge to become the Googles and Amazons of tomorrow.
Yeah, I'm not sure that we're going to find too many Googles and Amazons of tomorrow, frankly. I mean, that's a pretty rare bird.
Yep.
They're nice when you find them. Our basic principle, though, is we want to own businesses that have something about them, usually cultural, that results in them just outdoing what everybody expects. Because at the end of the day, that's where you get excess return, is when something outdoes what people expect. We have an idea in our company that we call defy the fade. And what that's a reference to is that most analysts look at businesses, they make a projection for a year or two, and then they just assume that because nobody can grow forever, the growth must fade down to GDP or something. It's a simplistic approach, and I don't begrudge people to do that when they have 400 companies to follow. But what it does is it gives us a great advantage if we can find those businesses that defy the fade because their culture keeps them either innovative, keeps them growing their competitive advantage. And I'm not talking about growing at 30% a year. What I'm saying is it's just as good to find a business where everybody expects it to grow 5%, but it actually grows 7%, because then you get excess return in the stock price. So to your question of what are you looking for, what are you finding, we're still looking for those great businesses that have sort of unique positions, sometimes in really sleepy industries that nobody cares about, but they have a cultural advantage that lets them just sort of take over. One of our recent purchases is a business that's sort of by country. It's called Mettler Toledo. They make measurement equipment for laboratories, and they sell into healthcare. They have, it's a very boring industry. It's kind of sleepy. They've got an amazing culture that supports their competitive edge, and they are taking share like crazy. We think it's going to be a great returner for us, but not because it's the next Amazon. But that's the kind of thing that characterizes the portfolio. It's got those kind of businesses. It has FANG businesses. It ends up, again, thinking about protecting the downside. It ends up making it kind of an all-weather portfolio, and that's where we want to be.
Indeed. So your purview is a global one.
Yes.
What are you seeing elsewhere in a global context that is exciting you?
We are finding some real opportunities in healthcare these days, and particularly from what you would call the picks and shovels approach.
Yeah.
You know, if you think about healthcare from, say, the pharmaceutical perspective, you tend to end up with so-called binary outcomes. They either get approved or they don't. They're either a blockbuster or they're not. But guess what? If you can find those businesses that are benefiting from the changes in the healthcare scene by making the rather mundane things that everybody needs that aren't binary in their outcome, like approvals of drugs, then you might have something that nobody's that excited about. One business that we bought recently is called West Pharmaceutical. They make the various packaging materials for biodrugs, biosimilars, things like that. What a lot of people don't realize is that the packaging is part of the approval process as well. The packaging has to be pretty high tech. It's a low cost of the whole drug product, so it isn't a big factor in terms of the cost of the thing, but it also means that the drug companies are not incentivized at all to try to switch suppliers because it's not that big a deal. And yet it has to be approved, so what you end up with is an extraordinarily sticky business because Pfizer or whoever is not going to go back and get their drug reapproved if they want to change the packaging on it. So West Pharmaceutical is making what we call picks and shovels, and they're a huge beneficiary of the move to biosimilars and biodrugs.
Now, Kurt, you're also working on new products, which include some which are going to be more accessible to the average investor.
Yeah, for example, here in Australia, we are launching in conjunction with Contango what they call an ETMF, an Exchange Traded Managed Fund, which will be our global strategy in a vehicle that's accessible to pretty much anyone. And we're excited about launching that coming up in a few weeks here, I think.
Wonderful. Well, Kurt, it's been a pleasure talking to you. Thanks for your time.
Thank you, Tom.
And thanks for joining us for the Executive Series.